The 1980s are remembered for Wall Street's boom years, but beneath the champagne and trading pits, a quieter crisis was brewing. Across America, savings and loan associations, or S&Ls, were failing by the hundreds. What began as a niche problem turned into one of the largest financial scandals in U.S. history, costing taxpayers over $100 billion. Savings and loans were once simple institutions. They took deposits from local communities and issued home mortgages. But in the late 1970s and early 1980s, high inflation and rising interest rates upended the model. S&Ls were stuck with long-term, low-interest mortgages while paying more to attract deposits. Losses mounted. Congress responded by deregulating the industry. S&Ls were allowed to make riskier investments, including commercial real estate and junk bonds. The hope was that freedom would save them. Instead, it unleashed a wave of reckless speculation. Unscrupulous owners took advantage, lending to themselves, engaging in fraud, and chasing high-risk bets. By the mid-1980s, hundreds of S&Ls were insolvent. Regulators, overwhelmed and under political pressure, delayed interventions. Losses mounted until the crisis became unavoidable. The government created the Resolution Trust Corporation to take over failed institutions, liquidate assets, and clean up the mess. The scandal exposed deep flaws in regulation and political influence. Some politicians were implicated in the Keating 5 scandal, accused of intervening to protect S&L executives. Public trust in financial institutions was shaken, and taxpayers bore the massive cost of bailouts. Yet the crisis also reshaped finance. It accelerated consolidation in banking, increased oversight, and served as an early warning of what unchecked deregulation could unleash. For Wall Street, the savings and loan crisis was a reminder that even small community institutions can become systemic risks when greed and politics mix.